Hello and welcome back to another video on the ComLucro channel. Understanding fair value gaps is essential if you want to read how institutional money truly moves and position yourself with precision within market structure. In this chapter of our Smart Money Concepts course, you will learn how to identify clean and reliable fair value gaps, understand the psychology behind their formation, recognize the different types that appear on the chart, and analyze the price action linked to each one. We will also walk through the key criteria that separate a simple gap from a high-quality trading opportunity, helping you trade with clarity and confidence in line with institutional flow. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. So let us get started. Before diving into the basic and advanced features of fair value gaps, let us take a quick look at market sentiment and understand the psychology behind price movement. At the core, there are two primary forces that consistently drive how the market behaves. The first force is liquidity zones. The market is always seeking to sweep liquidity to generate momentum. In simple terms, liquidity acts as the lifeblood of price movement and is essential for the market's overall function. We've already discussed how to identify liquidity zones in previous videos, which are linked in the description. If you haven't watched them yet, you can easily access those lessons through the link below. The second force is the fair value gaps. The market repeatedly shows a natural tendency to return, fill, and rebalance the inefficiencies left behind. If you look at this example, you can see that price made a sharp drop with clear inefficiency, leaving a fair value gap. After that move, price retraced upward, filled the gap, and continued to push higher to clear external liquidity. Once that external liquidity was taken, price reversed again and filled the most recent fair value gap. This cycle highlights the core behavior of the market, where price aims to sweep liquidity and rebalance gaps. Now let us move forward and explore how to identify fair value gaps from the candlestick perspective on the chart. Fair value gaps are typically formed within a 3-candle sequence and are easy to spot on the chart as a large candle. The key characteristic is that the upper and lower wicks of the surrounding candles do not fully overlap the body of the middle candle. This creates what we call the fair value gap zone, which fills the empty space between the wicks and is drawn based on the body of the middle candle. There is one exception, where a 4-candle sequence must be considered to identify a valid fair value gap. When the first candle in a 3-candle sequence is an inside bar that forms within the range of the previous mother candle, we need to analyze a 4-candle sequence to mark the correct zone. In situations like this, if we ignore the mother candle when drawing the fair value gap, the result will not be accurate or optimized. For example, in this case, if we focus only on the 3-candle sequence and disregard the red mother candle, the identified gap would be incorrect. These concepts also apply in bearish markets. It's important to remember that these principles work across different timeframes and on any price action-based chart. Now let us look at the theory behind fair value gaps. Consider a 3-candle sequence as shown. Let us assume that this bullish sequence, which created a strong imbalance, formed on a higher time frame. To understand it from a market structure perspective, let us zoom into a lower time frame. Here we can see that price built a bullish structure, similar to the one illustrated. As mentioned earlier, the market consistently tends to fill and rebalance the gaps it leaves behind. Now, let us take a closer look at the logic behind this behavior. As you can see, price created a series of bullish movements to the upside, with strong momentum caused by heavy buying pressure and a lack of sellers. When traders see sharp movements like this and miss a good entry, they often place buy limit orders below key zones, such as order blocks and demand areas, hoping price will pull back deeply to trigger their orders before pushing higher again. This behavior accumulates many pending buy orders in that region, forming a large liquidity pool waiting to be swept inside the fair value gap. So traders, fair value gaps often contain many buy or sell orders, creating significant liquidity inside the zone. This is the main reason why price tends to return, fill the gap, and then continue with even greater strength. The presence of these pending orders acts like a magnet that pulls price back to fill the void before the trend resumes. This can offer a strong trading opportunity for us. Imagine a scenario where the price experiences a downward movement. In this case, a fair value gap, also called a liquidity gap, emerges due to the absence of buying pressure across that specific downward move. Please note that the identification of the gap is based only on the impulse up or impulse down candle together with the adjacent candles. Any other candles outside this range do not play a role in determining the gap. These pockets of liquidity voids are important because they can act as strong entry points due to the market's natural attraction to liquidity. When price is inclined to move downward, it aims to clear the potential liquidity zones above it. As a result, these zones may become areas where price briefly pulls upward to fill the gaps before continuing its bearish momentum with greater strength. As we understand the psychology behind fair value gaps, now let us see how we can use them to identify the market's upcoming movement and direction. The key factor we can consider when determining price direction is the price action that unfolds as price enters the fair value gap. If price respects the fair value gap and shows rejection to the upside, it suggests that price may move upward to reach the most recent buy-side liquidity accumulated above the previous high. Conversely, if price shows no reaction upon reaching the fair value gap, it indicates that the market is more likely to move downward to target the sell-side liquidity accumulated below the recent low. To strengthen our understanding of fair value gaps, let us see how to identify them on the chart. Consider a series of bullish candles as illustrated. We begin our analysis from the bottom of the candle series. Here we have a 3-candle sequence represented by these 3 green candles. If we draw lines from the upper wick of the first candle and the lower wick of the third candle, we can see a gap between them. Moving forward, we find another fair value gap inside the next 3-candle sequence. However, price later pushed downward and filled all of those gaps. Continuing the move, we see strong upward momentum. So where is our next fair value gap? By drawing lines from the upper wick of this bearish candle and the lower wick of the following green candle, we identify another fair value gap created between those candles. Next, slightly higher on the chart, we see another 3-candle sequence. But when we draw the lines again, there is no gap between the candles, meaning there is no fair value gap to identify. Once again, if we consider these 3 candles and draw lines from the upper wick of the first candle and the lower wick of the last candle, we see that there was a gap between the candles, which is mitigated and rebalanced by these 2 candles. Next, we have another 3-candle sequence at the top. If we draw lines, we can clearly identify another unmitigated fair value gap here. So in this bullish candle series, we have identified 2 unmitigated fair value gaps, one located at the top and one located at the extreme. Price often pushes back down to fill the liquidity voids in these fair value gaps before continuing its bullish momentum. Price can reverse from the upper fair value gap, or it can move lower to mitigate the fair value gap at the extreme. Both scenarios are possible in the market. The same concepts apply in bearish conditions. Now, let us take a quick look at a real chart to see how we can use the fair value gap concept in market structure mapping. Here, as you can see, the dominant direction of price is bearish. To identify fair value gaps with high probability, we first need to wait for price to form a valid break of structure. Here, we see that price pushed to the downside and broke the previous major low, closing below it. This gives us a valid break of structure. Next, let us identify potential fair value gaps formed by the recent bearish momentum. In a bearish market, it's essential to analyze the chart from top to bottom to locate fair value gaps. While in a bullish market, the analysis goes from bottom to top. Starting from this high point, we begin our review. Here, we encounter a 3-candle sequence at the market extreme. By drawing lines from the lower wick of the first candle and the upper wick of the third candle, we identify a clear, unmitigated fair value gap positioned at this extreme point. Upon closer examination of the chart, it becomes evident that there are no additional fair value gaps within this internal bearish impulse move. Now, we can see an inside bar candle pattern that formed just before the price created inefficiency in the market with this large momentum candle. As previously mentioned, in cases like this, identifying a fair value gap requires analyzing a 4-candle sequence instead of a 3-candle sequence to highlight a valid and optimized zone. Therefore, we should draw lines from the lowest point of the mother candle and the upper wick of the 4th candle to highlight the valid fair value gap. However, it is important to note that this fair value gap is mitigated by price, and we cannot consider it as a trading opportunity. So, inside this bearish, impulsive movement, we have identified 2 fair value gaps. One of them was mitigated by the price action, while the other remains unmitigated at the extreme. As previously discussed, prices are more likely to return to fill and rebalance the gaps before resuming their primary trend. Therefore, what we should do here is wait for price to retrace back up to fill the gaps it has left behind before continuing its bearish momentum. Let us see what happens next. As you can see, price pushed back up again and, after filling the fair value gaps, reversed its direction and resumed its bearish momentum. Now, let us move into essential criteria and rules that we need to consider to identify and use fair value gaps to execute trades in the market, and understand how we can use them to our advantage. Rule number 1. It emphasizes that when considering a fair value gap for executing trades and as an entry point, price must lead to a break of structure or a change of character in the market. Without a valid break of structure or change of character, we must not execute any trades based on fair value gaps, because these elements are essential signals that indicate whether the market will continue in its initial direction or experience a reversal. Rule number 2. In a bearish market, our focus should be exclusively on fair value gaps situated in the premium zone when seeking to initiate short positions. Conversely, in a bullish market, our attention should be directed solely toward fair value gaps positioned in the discount area to execute long positions. Rule number 3. Fair value gaps situated at market extremes hold a higher priority for trade execution compared to those found elsewhere. Rule number 4. It must be unmitigated. Fair value gap areas are considered one-time use, meaning we focus on the trading opportunity when price first enters a fair value gap. Once a FVG has been mitigated, we do not consider it an area of interest for future trading. With these rules in place, you now have a clear framework to identify, filter, and apply fair value gaps with precision. When used correctly, they help you stay aligned with market structure. Avoid low-quality setups and position yourself where institutional flow is most likely to respond. Understanding the mechanics is important, but knowing when a fair value gap truly matters is what transforms this concept into a reliable trading tool. Before we close, take a moment to reflect on one essential point about emotional management. Many traders fail not because their strategy is weak, but because they underestimate how losses affect their mindset and decision-making. What happens inside your mind during a drawdown matters far more than the loss itself. To reinforce this idea, we are going to show a short clip from our video, How Beginners Can Learn the Discipline of Millionaire Traders. In this clip, you will see the first 2 foundational steps to develop the mindset of a millionaire trader, even though the full video goes much deeper into the complete process. Let's take a look. Step 1 is awareness. Change begins the moment you notice yourself. Awareness starts in that split second before you click buy. Ask yourself one question: logic or impulse? If the answer comes from emotion, the outcome is already decided. Research from UCLA on affect labeling shows that naming an emotion reduces its intensity. When you name what you feel, you take back control. Awareness breaks the loop. It is how you stop trading for stimulation and start trading for mastery. Step 2. Replace the reward. This is the mind reprogramming. Most traders celebrate profit, but professionals celebrate discipline. When you say, nice, I made $100, your brain releases dopamine for the money, But when you say nice, I followed my setup, your brain releases dopamine for control. You are teaching your mind to feel good, not when you win, but when you do the right thing. And as authors like Mark Douglas note, discipline is the real flex. This is how you rewire the reward system. You make consistency feel like victory. That clip is a timely reminder that consistent results come from discipline, not emotional reaction. The best traders stay grounded, keep structure, and treat trading like the serious performance activity it is. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.